And now it's time to bring in our first guest, Ed Slott. Ed is an author, speaker, and a television host. He's been called the best source for IRA advice by the Wall Street Journal and America's IRA expert by Mutual Funds magazine. And we're excited to have Ed back on the show here on The Income Generation. Thanks again for joining us.
Great to be here, Dave.
So first of all, since you follow this stuff much more closely than I do, or frankly almost any other financial advisor out there, do we have anything new coming up in terms of legislation that's been passed that's going to be impacting IRAs in the next year or so, or things that you think are on the brink that might be going to Congress that affect IRAs? Talk to us about that.
Well, there are some things in the works, and I have a feeling, I hate to make, I have to give you a Yogi Berra quote because, he said, I hate to make predictions, especially about the future.
Yes.
That's how I feel with tax law. Like they could have it wrapped up with a bow on it, and then somebody does something at the last minute. But here are some of the things they're talking about. They're talking about allowing you to make IRA contributions past 70 and a half. Right now, you can't do that. And that kind of makes sense. A lot of people are working well into their 70s, but there's this arcane rule that says for an IRA contribution, once you're 70 and a half, you can no longer contribute. While with a Roth IRA, there is no age restriction. So I think that's something that will pass and allow more older workers to keep contributing, which is important given today's life expectancy. There's also a rule to set the date for those RMDs, required minimum distributions, that most people can't stand. This is when you're 70 and a half and the money has to start going the other way and come out. So they have this 70 and a half rule. Nobody knows where this came from. My idea, and this is probably close to the truth, two congressmen in a bar. One says 70, one says 71. They roll down the hill. Somehow it was 70 and a half for years and years. So finally, and this confuses a lot of seniors, the half year. Am I 70? Am I 71? So they're thinking of getting rid of that and just making it age 72. I think that's a good change and will simplify things for people. They're also thinking about toying with the post-death distributions. People call that the stretch IRA. When you die and leave an IRA to beneficiaries, right now some beneficiaries can go out 40, 50, 80 years, depending on their age. They're thinking of cutting that down to 10 or even 5 years. I don't know about that one. I think that's going to create too much complexity and make it too much to manage.
Well, it's going to increase the government's tax revenues, which is probably one of their motives in doing so, right?
Yeah, but it really won't. What they don't understand is how people work, act in real life. They look at numbers. They say, look at all these beneficiaries, young beneficiaries. They're going to stretch it out for 50 years. In the real world, most beneficiaries don't stretch it out. They have that money. They take that money out on the way to the funeral before the body's cold for the most part. That money goes out fast. So they're counting on money that is coming in anyway, because most beneficiaries don't wait 5 or even 10 years. They want to get their hands on the money. They don't even care about the taxes. You know why? Because they didn't earn that money. It's not their money. It's like gravy to them. So whatever they have left after taxes, they're fine with that. So I don't think this is a revenue raiser, and it'll cause more complexity.
It's like winning the lottery to a lot of people who inherit the money. Absolutely correct. So in the 1 minute we have left, I want to talk about the 50% penalty. A lot of advisors use this as a scare tactic. I even at least mentioned it on the show, but most people don't end up paying that 50% penalty, even if they make a mistake, from what I understand. Is that correct?
Yeah, that's a 50. Just to be clear, that's 50% penalty for not taking a required minimum distribution. 50% of the amount you take, that's it. And people miss it all the time for a number of reasons. Remember, it applies generally to older people. People get sick, people die. So you just file a form. It's called 5329, and you make sure you make up the missed distribution. And IRS, in virtually every case that I've ever seen, has waived the penalty. But you have to ask. That's the key. You file that form 5329 with your tax return, and in almost every case they waive. I've never seen where it hasn't been waived.
Right. But so the point is, it's important, it's there, but don't let some advisor use it as a scare tactic in order to get your money. So Ed, we need to leave it there in this segment. And if you come back with us, We'll be back here in just a moment. We want you to stay with us also. We're here on The Income Generation. I'm David Scranton. We're here with Ed Slott. We'll be right back. But first, let's welcome back author, speaker, and television host Ed Slott. So what are some of the major reasons? And we've touched upon them in the show today, but what are some of the major reasons why people, when they typically retire, they typically roll those 401ks, roll those 403bs, roll those 457 deferred comp plans over into IRAs? What have you seen historically, tax and otherwise, to be the benefits in that for so many people?
Well, you have more control in an IRA, but I'm glad you brought that up because most people think it's the only option. If you watch the TV commercials and you call one of these big fund companies, they answer the phone, roll it over, hello. They like it's the only option because that benefits the place who's getting your money.
Sure.
And it is for the most part the better option. You have more control over your money. You can do whatever you want, more investment choices, and you're away from your ex-company. And remember, most companies don't want to deal with you once you're out of there. You're an ex-employee. The last thing they want is to have people spend time with you when you're no longer producing for them. But there are other options. You could leave it in a company plan. Maybe you like the investments. Maybe you like the creditor protection. You have company stock. Or maybe you get a new job. You could go to a new company's plan. Or you might want to convert it to a Roth IRA. Or if your plan has an in-plan Roth 401k, you can do an in-plan Roth conversion. Or you might even want a lump sum distribution. If you have highly appreciated company stock, there are huge tax benefits. Most people in that situation miss out on those benefits because they're told to roll it over to an IRA. So if that's you, for example, you work for IBM and you have a lot of IBM stock in your 401k and it's highly appreciated, you might be better off doing something called NUA, net unrealized appreciation. Big tax break you should ask an advisor about before you do a rollover, because if you do a rollover, that's it. The option's gone.
And it's too late, that's right. But something that applies to, you mentioned a minute ago, applies to a greater percentage of our Income Generation viewers, and that is the question of Roth conversion. Please talk to our viewers about what are the pros and cons of a Roth conversion. For what type of people do you think typically Roth conversions can benefit them versus what types of people do you think maybe Roth conversions are not so beneficial? I know you can't paint anybody with a broad brush, but if you had to give some generalities, what would they be?
Well, personally, I have bias. I'm a big Roth IRA fan. And the reason is I like the idea of Roth income, which is tax-free. I like the idea of a tax-free retirement. Now, you have to pay money to get there. To move from an IRA to a Roth, you pay the tax up front, which most people can't stand. But if you look at the long-term big picture, at the end of the movie, you're sitting in a tax-free retirement. Now, that's a big hedge against the likelihood of higher future tax rates. Now, the idea is that you're going to be in a 0% tax bracket. So some people say, well, why should I do a Roth? I'll be in a lower tax bracket in retirement anyway when I pull the money out. Well, it won't be lower than zero. So that's my take on that. I mean, there's a lot of moving parts there, but you have to have the money to do it. You have to be able to write that check. Some people like the idea, they just can't write the check.
Yeah, and in the minute we have left in this segment, the new tax law, the Trump tax plan, has actually increased the benefits of Roth conversions. Has it not?
Well, you know what? It actually made it a little tougher because one of the things, and this was a big surprise on this year's returns, in one way it decreased the cost because of lower tax rates. And some business owners actually saw a big decrease because of that 20% deduction for business income. Some, not all. But if you're thinking about a Roth conversion, you first have to do an accurate projection. Because one of the things that people found out this year, I mean, we've been talking about it for, since it came out, but that was kind of inside baseball. But when they saw their returns and they said, this is how much I owe for the Roth conversion, it's irrevocable. You can't go back like you used to be able to do. So it's a permanent decision. So just make sure you know what the cost is going to be before you go all in.
No, I see your point. It has made it a little bit more difficult. The good news, though, is most people don't realize that taxpayers today, married filing jointly, making $100,000 are only in the 12% bracket. that's about as good as it gets around the world. So we need to take a commercial break right now. Stay with us. We'll be right back with many more words of wisdom, I'm sure, from our good friend Ed Slott. Now it's time to welcome back for one last segment, author, speaker, television host, and friend of the income generation, Mr. Ed Slott. So we talked about our required minimum distributions, but you know, a lot of our viewers are over 70 and a half, but a lot of them are not. So let's just broaden it up for this last segment. And if you could share with our viewers, what are some of the opportunities in the IRA world that a lot of people are missing? And conversely, what are some of the most common mistakes maybe that people make with IRAs that they're just not aware of? Help us out.
Yeah, well, we just talked about Roth IRAs, the big fit with the lower tax rates, and you can push more through. But some people are gun shy because they know they can't go back. I would say maybe do a series of smaller annual conversions, or wait towards the end of the year when you have a better idea when your income is, what your income might be for the year. Maybe when you know how much of a bonus you might get or what might bump your bracket. But don't shy away from the Roth. I think it's a fantastic way to build.
And just to be clear, Ed, you could do those at any age, correct? These Roth conversions.
You can convert from a 401k, from an IRA. Yeah, anyone can convert. There's income limit. I'm glad you brought that up. People still think there's an income limit. There was many, many years ago. That's been repealed for many years. Doesn't matter how much you make, you can convert. And actually, it can help other parts of the return. Here's another mistake we see all the time. I was going to say we saw this year. But when people take those required minimum distributions and they have, say, a 401k or an IRA, they think you can take them from any which way and mix and match. You can't. Your IRA RMD has to be taken from your IRA. You can't say, you know, I'll take that from my 401k. Because when people do that, they have a problem. They took too much from one and not enough from another. Or we even see husband and wives get mixed up because they think logically. And the problem is the tax law is not logical. You have a husband and wife. They're both over 70 and a half. They both have IRAs and they both have RMD. So the husband might say, let's take it from yours. You have a little more. We'll even it out. Can't do that. The I in IRA stands for individual. You each have to take your own. Now, in the bottom line, if they take the right amount, it's the same tax. So they think, well, what's the difference where we take it from? It's a big difference because now one's short and one took too much.
Mm-hmm. Now, there are no income limits anymore for Roth conversions, but there are still income limits for people who want to make contributions, $5,000 or $6,000 a year, for example.
Yeah.
Is there an end around that is legal still that people can take?
Yes. I'm glad you brought that up because as a result of the new tax law, it didn't mention it specifically, but in the conference report, they okayed a strategy we kind of call a backdoor Roth conversion, where if you make too much to contribute to a Roth, you can instead contribute to a non-deductible additional IRA, then convert it to a Roth. Many tax people said, oh, no, that's a backdoor. You can't do that. There's no question. The congressional report said it's absolutely legal. And last year, IRS came out and said, we think so, too. We're not going to challenge it. So it's a great way to push $6,000 for 2019. And if you're 50 or over, that's $7,000. And if you're married, you could double that to $14,000 and you're 50 or over. So you can push a lot of money into Roth, even if you didn't otherwise qualify.
So if your bottom line is if your tax man said that is gray area, you got to update them and say, no, it's not gray area anymore. Ed, very enlightening as usual. Really appreciate you being on the show.
Thanks, David. Great to be here.
And we appreciate you watching, so stick around. We'll be right back here on The Income Generation.